Thanks, Madison, and welcome everyone to this briefing on payments and trends to watch in 2019. So a bit about what we're going to cover today over the next 20 minutes to half hour. So first, we're going to define the payments landscape and think about how you could slice payments in terms of by vertical or by value chain and in other ways. Then we're going to look at three specific trends to watch in 2019. The first in peer-to-peer payments, the second in income and payroll, and the last one in point of sale and at the point of sale, both offline and online. And finally, at the end, we will recap and take questions. So without further ado, let's dive right in to define different aspects of the payments landscape. So one way to define it is by user. So here's a market map that's available for our clients, but you could slice the payments landscape by companies that are serving merchants or serving consumers, and then serving both together. You could also slice the payments landscape by value chains. So on the top left, we have the typical card network, credit card, debit card value chain in the US, and then on the bottom, we have Paytm's value chain in India and other countries around the world. But you can see here that the value chain is quite different, and the way in which the players interact and the incentive structures here are also quite different. And finally, you could slice up the payments landscape by payment domains. So this is just by different verticals of payment, whether that be business-to-business payments or payroll and income, peer-to-peer, bill payment, or payments at the point of sale, either offline or online. So today we're going to slice by payment verticals and payment domains, and we're going to look at three different verticals. The first is peer-to-peer, the second is income, and the last one is point of sale. And we're going to look at where those verticals are today, where they will be tomorrow or in the near future, and where they'll be in the more distant future, and what are some, I guess, further out possibilities for where these verticals are headed. So first, let's look at peer-to-peer. We see peer-to-peer and peer-to-peer networks in the US as leading towards closed-loop payments ecosystems, similar to counterparts in China and other areas around the world. So let's understand this a bit more. So today, US merchants pay high fees to participate in bank-backed open-loop card networks. So let's understand this. Visa and MasterCard, their primary customers are banks. They facilitate messages between banks around credit, debit, and other payment methods. Banks are rewarded with fees charged to the merchant. And while this makes merchants unhappy, there's really not all that much they can do about it in the US, because banks split the fees with consumers in the form of cashback and rewards. So cardholders, banks, and the card networks all are better off with the current system. However, in other parts of the world, namely in China for the example here, platforms have built up double-sided marketplaces of merchants and consumers and cut out banks and other middlemen in the payments value chain. Most notably are Alipay and WeChat. When a customer makes a transaction within their ecosystems, it's as simple as changing a ledger entry. Fees are low, and cost savings are passed back to the merchant and consumer. Banks and card networks are effectively cut out. In money terms, the difference is quite evident. So in a standard $100 credit card purchase in the US, $97.30 might go to the merchant. In a standard 100 won purchase via Alipay or WeChat Pay, 99.3 won might go to the merchant. So you can see here that the merchant is rewarded in that value chain and potentially hurt in the value chain of the US. So where does that leave us today, and what could peer-to-peer networks do about this, and how do they fit in? Well, peer-to-peer platforms like Venmo and Square Cash and Zelle in some sort of fashion might be the tip of the spear in sidestepping banks and card networks. While their total payments volumes are relatively small, peer-to-peer platforms are seeing fast adoption, like Venmo in this chart. At the same time, peer-to-peer payments platforms have poor economics and low margins. Consumers don't really pay a fee to send each other money and only pay when cashing out to a bank account. So what else could Venmo be used for aside from P2P? Well, as liquidity has increased in Venmo, Pay with Venmo as a checkout option now sits alongside PayPal and credit at checkout. So PayPal is now integrating Venmo as a way to pay into its broader e-commerce payments platform. And one interesting thing that we're seeing is companies on earnings calls are now starting to pay attention to Venmo. And you can see here within our platform, we could search for Venmo and then look at earnings transcripts where the company is mentioned. And we're seeing that Venmo is getting a lot more attention with mentions rising in 2018 and 2019. And similarly, Square's Cash App is demonstrating how mobile peer-to-peer payments platforms are now going mainstream. You can see here some tweets, and Cash App hit #1 on Apple's App Store for quite a while in 2018. Debit cards are another effort at monetization. For in-store payments, Venmo and Cash App have released debit cards that link to users' peer-to-peer accounts and have partnered with merchants to offer rewards around these debit cards. Cash App's Boost program, for instance, offers discounts to swipe at popular merchants like Chipotle and Shake Shack. Debit cards encourage active users and push liquidity back into the mobile app, leading toward a closed-loop payments wallet for Square. However, what none of these systems have managed to do is to create an entirely new payments infrastructure. Venmo, Cash App, and Zelle use legacy systems like ACH, wire transfers, and now push-to-debit services to allow P2P transfers, bank transfers, and payments to merchants. And you can see here how they've partnered with Visa and MasterCard, along with a host of other companies for Visa Direct and MasterCard Send, which are their push-to-debit networks. And again, here you can see that Venmo's instant transfer feature uses two of the most popular push-to-debit services, Visa Direct and MasterCard Send, which use debit card networks to allow for quicker transfers into consumer bank accounts. And it's no stretch then to say that popular US-based peer-to-peer platforms don't yet shift the value chain in a fundamental way. In the future, though, Square could build a full-fledged closed-loop ecosystem with its small business debit card. So imagine a scenario where a merchant gets paid via a Square terminal and then immediately uses those funds to pay a supplier with a Square debit card. For Square, there's no need to route the transaction over a debit card network, and Square can therefore afford to give the buying merchant a 2.75% discount, which it does, when the buying merchant uses that debit card at another Square merchant. And this number also happens to be the typical merchant discount rate charged by other processors. Bigger tech players like Famga could also build out closed-loop ecosystems, as they already connect lots of merchants and consumers on their platforms. If Famga were to allow merchants and consumers to transact in-app, peer-to-peer, they might create platforms that mirror their Chinese counterparts, and as consumers and merchants keep more money within their ecosystems, they could even offer broader financial services on top of sticky mobile wallets. For Famga, the first step is getting more merchants and consumers to park money within their ecosystems. To this end, they already offer a slew of services. Here you can see Amazon's financial services offerings. Amazon offers cash top-up into its digital wallet escrow service, bypassing debit and credit cards for e-commerce transactions, and 2/3 of Amazon Prime members have said that they would try banking with Amazon. Now let's move on to our second trend: how technology could make payroll faster and give employees more freedom with their money, as well as better cash flow. So what's the situation today? Well, today in the US, salaried employees are paid typically every other week over legacy rails. These include payroll cards, ACH, cash, and check. Most popular, though, is direct deposit, with over 80% of workers receiving income via direct deposit. The problem is these rails make it difficult to increase the frequency of payment. Paying employees more often using these rails is costly and could be cumbersome due to the amount of manual labor involved and banking availability. but paying employees faster matters a lot. Typical bi-monthly pay cycles lead to many Americans living paycheck to paycheck. Many have to turn to credit card debt and overdraft fees, which you can see here, to bridge the gap between pay periods. So what's going to happen tomorrow? Well, one option is for more employees to utilize tech companies that are fronting pay at low or no cost to workers. Tech-first startups like Earnin, Dave, and Even are fronting money to employees between paychecks. These startups are not payday lenders, and they do not make money by charging interest. Each company uses a different business model to turn a profit. Diving deeper on Earnin for a moment, Earnin lets employees track and get paid for the hours they work. When employees cash out, Earnin sends the money directly to their designated bank account. That money is deducted from their next paycheck. Earnin makes money off of voluntary tips, which employees can leave at every cash out. Players in the gig economy are also paying their employees faster with the help of players like Stripe, Square, GoBank, and Gusto, as well as card networks like Visa and MasterCard. Uber offers its contract drivers a push-to-debit service called Instant Pay, which allows drivers to cash out earned income up to 5 times a day. Delivery services DoorDash and Postmates offer similar services, called Fast Pay and Instant Deposits, respectively. And Marqeta is a key player here as well that is helping disperse funds to gig economy workers by using virtual cards and push-to-debit networks. And looking at the major card networks, here's a quote from Will Sheedy of Visa. "I think you're going to see bill payment, payroll, peer-to-peer payments, globally and faster payments where consumers are pushing value to any number of third parties. I think that's going to be the near-term opportunity for Visa Direct, which, as we mentioned, is their push-to-debit network." Now let's think about this. What happens in the future where, in a situation where employees are paid at the end of each shift, or let's say they're paid hourly, or immediately upon the completion of a project or milestone? For one, and alongside other trends, employees might start depositing money more into digital wallets. Money held in digital wallets is more liquid than in traditional checking accounts, as users can send money to each other instantly through these social peer-to-peer platforms. Digital wallets then could shift the idea of the traditional bank account. If money is easier to move and spend, it could be put to use immediately instead of sitting in a checking or savings account and collecting little interest. Fintech companies like Acorns already employ this strategy. Acorns invests spare change from everyday debit card payments. For instance, if a consumer buys a cup of coffee for $3.50, Acorns rounds up to invest the remaining 50 cents into the stock market. It's not so difficult to imagine a future scenario where income, like spare change from payments with Acorns, is instantly put to use and invested. Looking further out, faster payroll could lead to a situation where banks bid in real time to borrow funds, or where consumers have to employ bridge financing tools less, or where consumer spending habits might shift towards micropayments as opposed to recurring billing cycles. Now on to our third and final trend, the point of sale. Tomorrow's point of sale system is ambient and omnichannel. If you haven't guessed it yet, today in the US, plastic cards reign supreme. US consumers primarily pay with cash or plastic cards at the point of sale in physical stores. The average US consumer holds 2 credit cards, and according to a Federal Reserve poll, most US citizens would pay for a $10 purchase at a local store with a debit card, followed by cash, and then a credit card. However, plastic cards come with their own set of drawbacks, including time and security. U.S. consumers spend nearly 37 billion hours waiting in lines every year, according to the New York Times. And security is another challenge. Credit card fraud continues to plague consumers and merchants, and retailers are expected to lose as much as $130 billion in online card-not-present fraud through 2023. These two factors mean that plastic cards might not be the end-all payment method for consumers at the point of sale. A couple of shifts are on the horizon. First, U.S. companies, consumers, and merchants are starting to embrace QR codes. Here you can see all the global companies that mention QR codes, but more recently, U.S. companies are talking about them as well. In fact, US retailers, from Target and Starbucks to Walmart and Dunkin', are exploring QR codes to facilitate mobile payments and streamline the checkout process. Coupons redeemed via QR codes on consumers' mobile phones are expected to increase to 5.3 billion by 2022, up from approximately 1.3 billion in 2017. Another shift that's happening is broader than QR codes and has to do with mobile devices. Mobile wallets digitize existing plastic cards and make them more secure by transacting at the point of sale with tokens instead of actual primary account numbers, or PANs. This means that a merchant never knows a consumer's credit card number or other sensitive information. Mobile wallets are starting to gain traction at the point of sale. Apple Pay and Google Pay are the most prominent options in the US, and yesterday it was announced that Apple Pay hit 10 billion transactions this year. Mobile devices and mobile payments platforms use NFC to communicate payment information. Looking down the road, NFC could be used for Internet of Things machine payments in the near future. So imagine your car communicating with the pump to pay for gas without you taking out a card or your phone. Or imagine a connected laundry or vending machine one day initiating payments without requiring any point-of-sale device or infrastructure. Still, these points of sale systems of tomorrow, for example, major mobile wallets, don't shift the value chain as much as their overseas counterparts. Consumers in Kenya, for example, can top up an M-Pesa wallet with physical cash at any number of independent cashiers. No credit card is necessary. That's not yet the case in the US. And mobile wallets have to gain widespread adoption, and they have not yet done that. In fact, the number one mobile payments app in the US is the Starbucks app, not Apple Pay or Google Pay. Looking further down the road in the future, the point of sale will fade into the background as biometrics, like a fingerprint or iris scan, allow for secure, ambient payments. Indeed, news coverage of biometrics is on the rise, with lots of chatter around biometrics for payments. As in other areas, China is taking the lead on biometrics. Chinese retail giants Alibaba and JD currently operate cashless shopping outlets across China. Using integrated mobile apps, shoppers can scan any item in the store and order products for quick delivery, or check out within the app and walk out of the store. Fully functioning facial recognition tools can match in-store shoppers to digital shopper profiles, determining the name and identity of each visitor. And here's a pretty crazy stat out of China. On 2018 Singles Day in China, which is effectively the equivalent of Cyber Monday and Black Friday in the US combined, 60% of shoppers paid by taking a selfie or with a fingerprint scan. And in the US, companies like Amazon and other retailers are playing catch-up, while regulators are pumping the brakes on biometrics with user privacy concerns in mind. So those were our three trends. Let's recap. So we looked at where payments are today for these three verticals, for peer-to-peer, income, and point of sale. We looked at where they'll be tomorrow, and we looked at where they'll be in the future. For peer-to-peer, today it's better UX but legacy rails. Tomorrow, it's broader payments ecosystems, and in the future, it's closed-loop ecosystems with new infrastructure. For income, today it's direct deposit, ACH, check, and cash. Tomorrow, it's faster payments and potentially end-of-shift payments. And in the future, it's single accounts that are quick, digital, tech-first, and provide for potentially real-time bidding in terms of lending, micropayments, and much less bridge financing. For the point of sale, today it's static, tomorrow it's more fluid, and in the future there is no point of sale due to biometrics and other factors. With that, we'll take your questions. Okay. The first question is, what do you think of Apple's announcement yesterday? I find the concept of daily cashback rather than larger monthly or yearly payments very interesting from a behavioral economics perspective. Are there any other similar offerings out there? So in terms of Apple's announcement yesterday, to be frank, it wasn't earth-shattering in the sense that it was, a co-branded car deal with Goldman and as well as MasterCard. These are pretty typical of companies like airlines or hotel chains, etc. What was atypical, I think, is what this person asks in their question, which is the daily cashback for one, and also the fact that the card has no fees, which is quite interesting. But more than that, it's the association with Apple's ecosystem. So Apple's card really feeds back into their peer-to-peer payments platform, into their general apps ecosystem, and other parts of their services and devices. So that's really where things become interesting. But from a pure card perspective, it's not all that unique or revolutionary. Let's take another question now. Any views on where and when crypto will impact payments? So I think in terms of how crypto could impact payments in the near term, when we think about crypto, we have to think about what is or what are crypto networks like Bitcoin really competing with. And I think that if you think they're competing with mobile wallets or banks, that's partially missing the point. And I think that when you think about Bitcoin, it's a new currency. So really, the competition for Bitcoin is fiat currencies. And, you'd have to compare Bitcoin to, let's say, the Venezuelan bolivar, for example. And that, I think, is a very interesting conversation. But, barring some sort of, revolution in terms of the way we think about fiat currencies and how we transact globally, that is a very distant future. But looking closer to home in terms of what companies are doing, exploring cryptocurrencies such as Facebook and others, that is much more immediate. And Facebook's exploration of some sort of, if you want to call it a cryptocurrency for WhatsApp, for cross-border payments and remittances is really quite interesting. So that's how I would think about it in the near term and short term. Let's see. What type of retailers do you think will be the first in the US to adopt payment by face? What players in the ecosystem will most help them to get there? Yes, there are a couple of companies now that are exploring facial recognition technology, and I think there's a company that just came out of Y Combinator, either in their last cohort or in this most recent cohort, that is working to take the technology that powers services like Amazon Go or Alibaba and JD in China with facial recognition and monitoring of shelves, etc. They want to apply that more generally to retailers across the U.S. The question is whether or not retailers really can implement that at scale, and it seems like the ones who are best positioned to do that are really companies like Amazon that already have such a massive infrastructure of data and of tech talent as well. But I think other companies are certainly waking up. We saw McDonald's acquisition today of Dynamic Yield, yesterday of Dynamic Yield, which is a machine learning startup. So we're certainly seeing restaurants, retailers start to really think about this more critically as a way to cut costs and as a way to kind of embrace where things are headed. Let's see. We have one question. Will the importance of battery life in a mobile device increase as we rely more on them for payments and other day-to-day activities? That's an interesting question. I think battery life is already pretty important. It's a problem that's being worked on, by many companies out there. But again, we see the future headed towards biometrics and facial recognition. Mobile device is a piece of that, but not necessarily the whole piece. So, rest assured, battery should be hopefully not too big of an issue. What makes China the leading country of payments innovation? I think when we think about, and this will be our last question for today, but I think when we think about China, the reason why it's so innovative, or so, not even to call it innovative, it's more unique, is the way in which it disrupts the traditional value chain in the West. So as we looked at, the value chain today is at least in the U.S. and other Western countries where Visa, MasterCard, and card networks hold sway, the value chain is to run through them, and the customers there are banks, and merchants are very often hurt by that. But in China, the key customers there of Alipay and WeChat are merchants and consumers. So banks are effectively cut out, and the cost savings there are passed on to merchants and consumers. So that really is the innovation there. The innovation is in the value chain. Sure, there are obviously cosmetic differences. Their apps are very impressive, and they're really super apps that encompass many of the apps that we have in the U.S. But more than that, it's the disruption of the value chain. With that, I will pass it back to Madison. Thank you so much for listening today, and hope to see you again soon.